Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, lately, more and more investors are choosing to invest in small and mid-cap funds. And why not? This category has got them reasonably good returns in the past couple of years. But does that mean you should ditch your large cap funds? You should move out of large cap space completely? We'll talk about that in today's episode, and joining me is Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First of all, let's start with a very basic thing. What are large cap funds?
Large caps are, basically, broadly speaking, they're large companies, big companies. And 3 years ago, they got a clear definition, because what happened was, large cap was being referred as big companies in their respective, and the leaders of a specific industry or broad industry was being referred as one. But what happened was, ever since SEBI defined that these are going to be large cap funds, the fund classification, and then it went about defining that what is a large cap companies, because you can't define a large cap fund which was mandated to be investing 90% of its money in large cap companies if you don't define large cap companies.
Right.
So that is when it was decided, that is when it was defined. So this is actually SEBI's definition. That does not necessarily mean that it ends there. That definition is that top 100 companies by capitalization. So you make a list of all the companies, their market cap, which is market price multiplied by the number of shares outstanding, and sort them by descending order. Top 100 companies are large cap companies. That doesn't mean that 103rd number company is not large cap. It is pretty close to that. But this standard cutoff, the definition for the purpose of mutual fund is large cap, is that.
Now, what has happened in the past year actually, some reports state that people are investing more and more in small and mid cap funds, and they're taking their money out of large cap funds. Is that a wise thing to do?
That one is that it may not be largely true. One is that the large cap category excludes index funds, and index funds are getting a lot of money. So if you look at it technically, yes, large cap funds are not getting as much money, or maybe some investors might be taking money off large caps. But that doesn't mean that investors don't invest in large cap. The flexi cap and multi cap funds, which are very huge ones, is a huge category, and they are substantially invested in large caps. So that is not to say that, yes, they are not specifically investing in actively managed large cap funds. And I think actively managed large cap funds, they have lost their case. They have lost their case for a very specific reason. It is very difficult for them to beat the index, because the index is very less expensive. The cost of index is 10 basis point. The cost of an actively managed large cap fund will be 1%. So they have to generate 90 basis point more, 9/10 of a percentage, to just match the index. Then people say that why bother? And then the most other important part is that not that people are attracted to mid cap and small cap. People chase performance. Whatever has done well, people will invest money there. So if infrastructure funds start doing well, they'll put money there. If banking and financial services start doing well, they'll put money there. Right now, people are witnessing handsome return from small cap and mid cap, and that is why they're putting money. Maybe that is, if this carries on for a while, it will become too difficult to sustain that level, because it will just be too expensive. Ever in the past, small caps have done very well for a sustained period of time. They proved to be more volatile. They proved to be more volatile simply because they are, you are investing in small sized companies with small equity base, where the promoters hold substantial part of the shares. On top of it, little movement, if there is a 5% sale if the turnover goes up and somebody is selling those shares, the impact on small cap and mid cap companies is substantial, and that adds to the great volatility. And that is quite unnerving. Right now, investors have just seen one side of the story, that they are going up and they are investing, and they are thinking that they should not miss the bus, they should ride it. The converse will also be true. There will be time when investors will be running away from small caps, and that is when they will be on a free fall. They will be on a free fall at a much accelerated way than they are rising. Today they are rising very fast, and they will also fall very fast. And whenever that happens, if you are not there with the understanding that this is the nature of this beast, this is how it is, and you, to benefit in the long run, you have to withstand, or you have to tide over this thing. So if you're not aware of that part, better be aware of it and be ready, be prepared for those phases as well.
So should one at all invest in large caps alone, or is it the time to exit large cap funds?
Oh, a portfolio without large cap is unthinkable. And let me tell you why.
Right.
If you look at the capitalization of the Indian market, if you look at the, something like 2,800, 3,000 companies which are traded every day and somewhat regularly. And if you do a sum total of the capitalization of all these companies, top 100 companies account for 80% of the market cap. So if you don't invest in the large caps, you are missing out on the 80% of that. Right. Your playground will be 20%, though in number terms, they will be 2,600 stocks. So I can't think of investing without large caps. But the important point is that, there is a tailwind of the India story. The India story is happening, and it is considered to be the story of the decade, and isolated story of the decade, while the whole world is so gloomy. In that context, that's India story as it unfolds, it will happen in the mid cap and small caps. It will not happen in the large caps, or it will not happen exponentially in the large caps. Though large caps will also grow, they will also rise, but there will be extraordinary stories happening in the mid cap and small cap, and that is the charm, that is the lure of the small and mid cap which is attracting investors.
So to sum it up, you would say that large caps should still form the core of your portfolio?
Yes, if I have to really put some percentage to it,
right,
I would say that, ideally it should be 80% of your portfolio, because that is reflecting the market, and you can exercise all kind of selectivity there. But if not 80, have 50, because large caps actually come to play when there is a lean time. They provide stability to the overall portfolio. Not only that, it's not a loser's game to be in large caps. Large companies get even larger. They are large companies, and they are dominating their market for a reason. They are leading for a reason that, and that will also drive their growth. Yes, there will be extraordinary stories or growth stories in the small and mid cap segment. So my sense is that, have at least 50%, or have this, mental framework that it will be about half of your equity portfolio. That will provide stability. You will not be deprived of growth. Exercise your selectivity as much as possible.
If someone finds it really difficult to, choose large caps, mid caps, small caps on their own, is there an alternative?
Yes, the multi-cap fund. They are forced to invest 25% in large, 25% in mid cap, 25% in small cap, and 25% is their discretion.
Yeah.
So if you want to really have a selective exposure to the whole market, that is a better way of going it. And also, some of these funds are not very big.
All right, that's all we have for you in today's episode. Thank you for joining us. Thank you for watching this space, and if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.